This morning I want to talk about three areas of risk and one area of opportunity. The first area of risk is electoral risk or political risk. I'll talk about two markets. I'll talk about the US market and our market, and then I'll talk about the outlook for the US dollar and what that means over the next couple of years. I think there's significantly more political risk than in the US system than the market currently appreciates. The current ways in which trading engines which look at the US market operate is that in terms of the historical data, what usually happens is that the market stands away, stays flat for a period leading up until the election, and then kicks around about 2% in the period after the election. So that's kind of already happened. You already had that risk-on period in the US equities market. But 2020 is the year in which statistically low probability events happen, and I think it's entirely likely. I think we're in a situation where something that may not have happened in the US political system since the 19th century may be about to happen again. My understanding is that there are at least three states following the recent presidential election that are within a statistical margin of about 0.5%, which means they're going to be recounted. An additional state might also be Pennsylvania might be ordered, a recount might be ordered for that by the Supreme Court. And if 3 out of 4 of those recounts are actually benefit the president, what happens as a result of that is you get a tied level of electoral college votes, that is to say the number of votes in the electoral college in the middle of December is 269. And if that occurs, then Article 1, Part 2 of the US Constitution comes into play, where the election is sent to the US Congress for decision. And in that circumstance, it's state delegations, not the current people who are elected to the Houses of Congress, that make the decision. And as a result of this election, a significant majority in state houses and those state delegations is Republican, and hence would re-elect Donald Trump. So there's probably about at least a third chance that Donald Trump's still going to be president in January, and I think that generates would be unexpected by the current media, and that generates significant political risk to equity markets between now and December, and then running into January, because things that haven't happened for a very long period of time, like all the other things that haven't happened for a very long period of time, this year may happen again in the US political system. In terms of equities valuations, I have to say that my long-term valuation for the US S&P 500 is about 2,300 points, and that emphasises where the level of it should be relative to earnings. And on that basis, the US market's the most overvalued since the very top of the tech boom at the beginning of the century. But if I just constrain the model to the most recent period since 2014, I come up with a fair value of 3,066 points. And that makes the market 484 points overvalued yesterday, which is the most overvalued it's been in the entire model period since 2014. So I think what there is significant valuation risk in the US equities market, as well as political risk in the US system. And if I look at our market, if I look at the long-term valuations, including bond differentials, in the Australian market, I think our fair value is about 5,800 points. So I think we're about 500 points too high. And then we're about the same level overvalued as we were at the beginning of this year. So I think that there's significant political risk in the US. I think that there's significant market risk in the US. And I think there's significant market risk here. Where is the area of opportunity? I think is in currency. I've said before that there's enormous expansion in the US budget deficit here. It's over 20% of GDP, which is the biggest budget deficit since World War II. And the only way you can clear that volume of bonds that's necessary to fund a deficit that size is that there has to be a significant decline in the US real exchange rate to lead to a decline in the volume of bonds coming forward to be cleared in other currencies, in European and other currencies. And we've already seen a decline in the US dollar index this year from a significant multi-year peak down to pretty much equal to its low for the year in the last 2 days. Now I expect there'll be significant further declines in the US dollar over the next 2 years. I've said before that will generate a new resources boom, similar to the resources boom we lived through after the last major fiscal expansion earlier this century. And I think that that'll run from at least a year and a half from now on. And I think you've seen the beginning of that in kicking commodities prices in recent days. And I think that the opportunity, even though we have overvalued stock markets both in the US and Australia, I think the opportunity is in commodities. And I think there's a significant opportunity in commodities over the next year and a half. And that's enormous benefit to Australia as an economy relative to the US, because Australia is one of the world's largest exporters of a large number of leading commodities.